from management, so you can maybe do the management yourself. And management should be cheaper. Instead of paying 8-10% for multifamily, you might pay 4 to 6, maybe 8%.
Move over, baby boomers. It's time for Gen XYZ. It's time to stop waiting on the world to change. It's time to be the change. It's time to stop thinking about how your life can be better. It's time to start taking action, massive action to improve your life. Join Zach Winter and Mark Adair Rios every week as we learn how others had the grit, determination, and conviction to 10x their lives, and as we explore ways that can help you 10x your life. Welcome everybody to the latest episode of the 10x for Gen XYZ podcast. I'm Mark Adair Rios.
And I'm Zach Winter.
And today we have Alex Olsen of Exchange CRE. And Alex is an established commercial real estate agent. He's also a multifamily investment specialist located in Kansas City and works throughout Missouri and the Midwest. And Alex has over 15 years of knowledge, and he's built a system to help ensure that buyers succeed. It's called the Buyer Representation Success System. And I'm sure we'll talk a little bit about that. But he's also an expert in the complex subject of 1031 exchanges. And he insightfully serves his clients by identifying opportunities and helping them maximize value in the disposition. And also in 2021 alone, Alex completed over 30 transactions in the multifamily and triple net lease space. And that totaled about $40 million sold. So Alex is a rock star. Welcome, Alex. How are you?
Thanks guys for having me on here. I'm doing fantastic today, that's for sure.
Fantastic. Yeah. So, we're active investors ourselves, and actually we're starting to get into some dispositions, and not only in our own portfolio, but we have some, partners that are, or colleagues that are selling some of their properties too. And I always, wonder about some of these groups that are, exiting right now with these big profits, or at least a couple months ago, and why they're not doing more 1031 exchanges. It's pretty crazy, just kind of seeing and looking, people talking about, 2x returns and why aren't you looking at 1031,
Especially if you've done a cost segregation analysis and have accelerated your depreciation, because your depreciation recapture tax is going to be huge.
Yeah.
Yeah. It's so funny when you talk to different people, all different investment levels. It's like, some people have this thing where they want to get it out of the way. I want to pay my taxes now, so I don't have to pay them later. And I understand part of that. If you're at the end of the rope, you're done with active investing in the world, and maybe you think that there's going to be some kind of burden on your family. But the key to it that I tell people in that situation is, well, if you die with your investment, you won't have to pay taxes, and your heirs won't have to pay taxes because you get to step up in basis.
Right.
And so some people don't quite fully grasp that. And other people are like, we made so much money, we want to get all the partners paid off and we're going to move on. And, it's so interesting that people have so many different opinions on it. But of course, my opinion is it's the best way to leverage and scale and continue to build wealth.
100%. Absolutely.
Without paying taxes, at least at the time, right?
Yeah, that the ability to defer taxes after you've held the property and have depreciated it, and you have a massive capital gains and a massive depreciation recapture tax, the ability to continue to defer that is just huge.
Yeah.
Otherwise, it cuts into your profit on the sale tremendously.
Well, that you bring up a good point. I was just thinking about that, and I don't know how much you deal with syndicators or funds in your business. I'm sure you do a lot.
Sure.
But sponsors typically, if their CPA really kind of has their head on right, you don't typically get to share in the depreciation of the of the deal. And also you can't have a negative basis. So when you get K1s throughout the whole period, typically you're just zeroed out, right? Your basis is zeroed out. It's not negative like your investor partners usually are because of the accelerated depreciation. So at the very end, when you sell that property, there's potentially a significant tax hit for you as a sponsor when you step into your promoted interest and or carried interest, as they call it.
Yeah, people can get really behind on, behind the eight ball, so to speak, after that. And I think in those situations, the CPA, and I've seen it, believe it or not, syndicators that are maybe 2, 3, 4 deals in, and they have a CPA that just really doesn't understand real estate because they've used their local friend or whatever. And, oh, yeah, your basis will be this. And, oh, yeah, it's not that big a deal. And then, well, shoot, after you do your taxes, it's like, wait a second, how? I don't understand. Why do I have to pay my whole, 2022 income to to taxes? And then there's the other aspect of it too. And I hear this a lot. Maybe you guys hear it a lot too. And that is, well, I can't find anything. I can't find anything to 1031 exchange into. And that's obviously where we step in and say, well, look, we're going to give you the promise that we will at least put 3 properties in front of you that come close to meeting your exchange criteria. Whether or not you close on those, or is kind of up to you, of course. But you can always buy something and then do another 1031 exchange if you absolutely hate it.
Yeah.
And that's another last
That's interesting.
last option for somebody that I've had people do it, even clients where I somehow failed them, I guess. But it's like, hey, look, identify something and buy it a year from now. Let's sell it and let's go get something you really love, or maybe you really like this. Or if you're, let's say you're buying, you sold your down leg for $10 million, and you can't find anything for 15, 20, or 30 million. Maybe you can find a $10 million upleg property, or replacement property that at least allows you to defer those taxes as kind of a worst case scenario. So I think it's just, as you guys are partly alluding to, people don't talk about it enough and don't really explore all those options. The 45-day window stresses people out. And I just, it's kind of unfortunate, but it happens.
I think,
one of the things that I like about your program is I get emails every day about single tenant triple net lease opportunities for people to 1031 exchange out of whatever they're selling and buy a single tenant triple net lease opportunity that has no upside. And that's at like a 3, 4, maybe they're getting into the 5 caps now. And what I love about your exchange program is you're giving them an alternative where they can get in at a better cap rate, where it's got some value add, so they can really get a good return, not only deferring their taxes, but if that investment profile is what they're looking for, they can get, the potential of higher cash flow and a greater overall return.
That's exactly right. I mean, we have, there was a gentleman who's a client of mine now, but he had 16 units. There were 4 plexes. And he was really gung-ho. He did the old, knock on everybody's door, find the owner, find the phone number kind of thing. And these are really nice 4 plexes, garages, quite valuable, $1,200 a month in rent at the time, which was pretty good. Anyway, long story short, he bought all those one at a time. And he came to Logan and myself and said, hey, look, I want to 1031 exchange these, but I have no idea how to do it. I don't know what I'm going to get out of it. So long story short, we helped him sell that. We also structured his contract to where he had several extensions of his closing. So that way he had even more time to identify for his exchange. And then during his identification window, we found a great apartment complex for him in a submarket that's considered an A+ submarket, and off-market deal, of course. And he ended up partnering with one of his friends who, oh, by the way, we sold those duplexes for him, but they combined together. So he sold his 16 units and ended up buying a 91 unit apartment complex.
Nice.
All tax deferred. And oh, by the way, now he bought that for like 7.1 or something like that. And now he's selling it for 10.5. So, and then he's going to 1031 exchange again, of course. That's one of those things where, I mean, that's not a unicorn. That can happen with the right structure set up. I mean, that took 6 months to take all that stuff down, but you go from 16 to 91 within 12 months. That's pretty powerful.
That's pretty amazing.
Yeah, we call that cascading up. Right.
Yeah.
Like if you can maintain that loop and keep on doing that all the way to, like you say, to death, right? You get to pass on that stepped up basis tax free, basically, to your kids. And now they get to start the whole process. Hopefully they like real estate. But,
Right.
but I don't know.
That is the ultimate tax deferral, right? 1031, 1031, 1031. You pass on, your heirs get a complete step up in basis.
Totally.
Yeah. Yeah. And hopefully they like it. If they don't, I guess they could sell it, or maybe they put an asset manager on and pay
Right.
them,
Well,
$100,000 a year or something.
They'll be shaking their hands at you though.
Yeah.
Like, dad passed on this real estate and now I got to pay taxes. Come on, man. But
maybe what would be helpful for our listeners who aren't that familiar with the 1031 exchange process, but maybe have a sale coming up or they're thinking about selling, talk a minute about what the basic parameters are and requirements are for 1031 exchanging, including making sure that you use an accommodator.
So just real quick before you start, I wanted to ask this earlier, just kind of also delineate, because it sounds like you do agenting, you help people with 1031s. Are you also a facilitator, or are you really on the brokerage side?
We're just a brokerage firm. So we're just a standard commercial real estate brokerage that happens to be one of, at least we think, one of the few that really focuses on the active brokerage investment side. And how we help people, and I'll get into really the exchange here in one second, but how we help people is, like we talked about, right? We're really, our main objective is finding them properties to exchange into, and then setting up their whole team, right? The property management, attorneys, insurance, everything they would need, asset managers, construction managers, and really just be their, it's not boots on the grounds, because we have a lot of local people here too that do this. So, but it's more like, just their consultant. And we just make money on once the deal closes. And so taking a step back into what an actual 1031 exchange is at 1,000-foot view, you've got any property you can sell, any real estate investment property, it has to be real estate that you own, you can sell and defer those taxes, the gains that you would make on that, by exchanging into any other real estate property. So, and in and out of any other state. So you could sell a property in California and exchange into Texas. You could sell farmland in Iowa and exchange into multifamily into Nebraska. So that's a key thing there. And the other piece to it is, during that exchange period, you only have 45 days to identify 3 properties.
And just to be clear, that's 45 days from the close of escrow on the property you're selling.
That's exactly right. From the moment you're down leg, the property you're closing on sells, you have 45 days to identify up to 3 properties. And there's some other ways to identify more than that. But you can, get into cuckoo banana land sometimes if you're trying to get too cute with your exchange. But so you have 45 days from the moment that your down leg closes. And then you have, from that same date that closes, you have 6 months to close out 1, 2, or all 3 of those properties you identified. So it is time constrained. And the IRS doesn't care if it's on a Christmas or New Year's Day, your mom has cancer, or you get hit by a truck. So those are hard and fast dates. Yeah. Just like, the IRS is pretty hard and fast on their dates on when you got to get your tax return in. So it's the same here. And, that's the basic overview of it.
And then the other key, right, Alex, is the accommodator. The money cannot go into your personal bank account. If it's even for 10 minutes in your personal account, that's it. You've blown the 1031.
That's right. And we help people what we call, qualified intermediary. And there's some really great ones out there. The truth is, anybody that's arm's length away from you can be considered a qualified intermediary, but that is not something I would ever advise anybody to do, because you want to choose somebody that knows the ins and outs and how to take and control funds, and because they're holding your actual funds, not holding in an account that's assigned to you. They're holding your money in their account. So you got to trust them. And, it doesn't matter where they're located. They could be located in Missouri, California, anywhere. And we just really choose the people that do the most transactions because they know the most about it or the most trusted. The other piece to your exchange, and by the way, you have to do that, the combination piece, a qualified intermediary, before it closes, before it hits escrow, all that kind of stuff. So you're doing that, preferably either right when it goes under contract, the property you're selling goes under contract or shortly thereafter,
right,
just to make sure you got your ducks in a row. The other requirement, I guess, to defer 100% of your taxes is the property that you buy. So your upleg property has to be equal or greater than the property you're selling, the sales price and the buy price. And then you also have to make sure that you're replacing that same amount of debt. So if you've got $1 million property that you just sold and you only owed $500,000 on it, you got to make sure that you put that $500,000 worth of debt at least onto the property you're identifying, which is, in that scenario, that's a common one because you'd be leveraging 25% if you go and you buy a $2 million property. Most people like to leverage as much as they can out of it, but really talking to your CPA, understanding your total tax implications, and understanding all of your timelines is extremely important when you're completing a 1031 exchange.
And if you see an upleg that you really love and think it would be great, but it doesn't fully meet either the debt requirement of meeting or exceeding the debt on the property you're selling, or the purchase price requirement of meeting or exceeding the purchase price of the property you're selling, you can still do the deal. It's just that the difference is treated as taxable boot. Is that correct?
That's right. Yeah. So you're not able to defer 100% of your taxes, the gains taxes on that. So you have two options. One, you can pay the leftover boot tax, or you can, buy and close out another property, which is why we always recommend to have 3 properties identified. One of the 3 should be something that it's probably overpriced. What we coach people is identify your third property as overpriced, something that's probably been on the market a little while, and something that's pretty dang nice, meaning it doesn't require a lot of work. Because if that's your worst case scenario, yeah, you had to overpay for something, but you got something that's pretty dang nice. And since it's your third one, since it's been on the market for a long time, it's less likely to sell, or maybe it's even off market on one of our lists, or something that is going to be there at the end of your 6-month period as your absolute backup.
That's probably one of the only times you want to go to LoopNet to find it.
That's
You'll
right.
probably get one.
Yeah. What's the oldest? What's the property on LoopNet that's the most expensive per unit but fits my criteria? Yep, that's probably the one I should identify.
Well, you brought up I wanted to just ask a question on that point, because I had traditionally seen, we do value add multifamily and commercial, right? We like to kind of actively increase the NOI. But obviously you can 1031 into those types of deals, but I see a lot of and you play in this field too, a lot of the triple net lease, single tenant stuff, newer stuff. Can you just talk to us just a little bit about why investors, I can understand your third choice thing, but why that would be the first choice for many investors? Is it just kind of ease of use? Like, okay, this one's going to run by itself. I did enough active, let that thing go, and we'll just keep on cascading up, and I'll concentrate on some other stuff.
Like maybe they're at that stage in their life where they're looking to be more passive and they just want kind of mailbox money.
You're talking about why would somebody select a triple net lease?
Yeah, just outright from, say, coming out of a multifamily where they had just magnificent kind of returns up until now, right?
Yep. So yeah, we have a lot of people that come to us that say, hey, look, I'm an out-of-state investor, or I'm a local investor. I've done the multifamily game. I hate it. I can't stand working with my property manager. I want something I can manage. So you've got a couple options. Obviously, you can do a single tenant, triple net lease building. Maybe it's just a standalone Dollar General you can get for a 6.5 cap or so. That's got 7-8 years left of their term left. Or maybe it's a neighborhood retail shopping center that's got 5 or 6 tenants in it, and one of them's a regional tenant and they're smaller footprints, and maybe they have shorter terms, but you don't get the squeaky, the leaky toilets, my roof's on fire. I might get the roof's on fire kind of calls, but you don't get some of those annoying calls because the tenants are in theory business owners, right? Versus just humans living there 24/7. Right. And so people feel that way. And I think it is true. It's a lot less labor intensive from a management. So you can maybe do the management yourself, and management should be cheaper. Instead of paying, 8-10% for multifamily, you might pay 4 to 6, maybe 8%, depending on the building and asset type in the triple net lease space. You don't get the appreciation typically that you see in multifamily.
Right.
So it just is and it's a coupon clipper, like you said, maybe somebody that's 65, 75. We've had people come to say, hey, look, I'm going to sell my 162 unit apartment complex. I just want to buy 3 Starbucks.
Right.
But of course, they wanted a 6 cap. So that throws that out the window. But, that's just what they want. They want something that sounds cool, that they're proud of, that they're, excited about for at least for that moment, and don't have to ever worry about it, is what they're thinking, or at least during their lifetime. Right.
Yeah.
So, and there's also other people that say, I really like this retail space, that they want to get into, and maybe they have had experience in the past, and they just want to continue to build that portfolio of the good quality retail tenants. There's a lot of bad retail space out there that has to be completely fully redeveloped and made into a Class B or Class A product. And that takes a lot of time and effort. And people are like, you know what, I could just take this, 10 space shopping center or business center and make a few bucks at it. Even if the price, even if the value never really goes up and the leases are there, I'm still getting my cash flow. So at that point, it's just really a lot about cash flow, not about turn and burn and really exchanging in and out of properties. It's, I'm going to have this thing for 10, 20 years, and it's just going to give me, $100,000 a year in cash flow or whatever.
Yeah. That's what's happening right now too, right? Like I think a lot of investors, in fact, we were just chatting about, there's some economists that are out there right now kind of promoting this shift in real estate where the value add kind of stuff, the 3 years, 4 years stuff, still there and still viable in a lot of ways if you have your capital right. But a longer term kind of outlook is probably going to suit most people well in the face of a coming recession, right?
Yeah. And, the recession stuff, I say stuff because recessions happen and come and go, and you can never, at least I can't, I'm not smart enough to, and I think most economists aren't, they might think they are. Right. You can never see through to the other side. So, recession's coming at some point, but you can't see through the other side. And so, of course, that's when everybody gets more conservative and pulls back on their metrics, rightfully so, to a degree. And so you get this moment where everything kind of slows down until the dust settles.
Yeah.
And we don't know, maybe when we come out of this thing, retail is going to be super hot because it's super cheap, and maybe there'll be money just dedicated towards retail or office, because it's sitting there vacant. So that's the beauty of real estate, is there's so many opportunities really across the board. It's just how you want to play in that space and how confident you feel you can make money in that asset class.
I love that.
Alex, are you doing Delaware Statutory Trust or DSTs as an alternative?
Yeah, great question. So that's another. So I'm going to take your question and kind of expand on it. So there's really kind of 4 options for people in an exchange. There's might be more, but 4 main options. Of course, is remaining a completely active investor, buying and managing real estate. Then you have a tenancy in common option, a TIC option, where you have to find other partners that are like, yeah, we'll take your 1031 money and your business essentially and combine it with this other investment deal. And now you've part owner in this investment deal. And then you have asset managed property, which I alluded to a little bit, where somebody says, I want to be completely out of this thing. I'll just take this property to break even on it, or I mean, they want to make money, but I'm just exaggerating because the asset management fee is so high. Somebody manages the asset for you, and all you do is take a paycheck every single month. So that person's kind of your employee. And then the fourth option is the DST option, which you just mentioned. We don't do a ton. We actually don't do a ton of DSTs. We have partners that are really, really good at finding quality funds for people to invest in. It's kind of, in my world, the last resort.
Right.
Again, typically for people that are near retirement or want to. And the returns on those, at least what we look at, are 3, 4, 5, 6%. It's not very good compared to any of the other options. However, it is an option, and some people do use that as their third. You got your three options when you're identifying something. Some people do use that as their third option, but I have found probably 8 out of 10 times. I'm not saying this is the right thing to do, but when they get to that as their third option, the other two have sold and they've waited too long and been too slow with it. That third option, they go, I don't want to do that, man. I'm just going to pay my taxes.
Yeah.
Just because it's not that.
Yeah, the returns are not that attractive. It's probably, on the spectrum. Well, maybe you could consider it the safest, the most sure mailbox money, but the percentage, the return on your investment is going to be the most modest.
Yeah. What do you do? I mean, we haven't even hit 6% inflation, right now. I mean, let's be real. I'm not knocking, like, there are great deals out there that kick off 6%, annualized or more, but knowing that going in and knowing that after you spend your initial money on these DSTs, you can't put any more capital into it either, right? They can't go to you and say, hey, we need more money. Like, the LLC that owns that property is locked in. And so you got a little bit of time to do.
And your point, Mark, that if CPI is 9.1 and your Delaware statutory trust is only spitting off, for example, a 6% return, probably at best, you're losing money every year because of inflation. But, one question I had, Alex, is let's say you go into a Delaware statutory trust, which I get, it's not technically, you're not 1031 exchanging, you're taking your proceeds and putting it into a Delaware statutory trust, and that enables you to defer taxes. When you sell out of the DST, are you then taxable?
Yes.
You can't 1031 at that point. You're done.
Well, you can continue to move that money within a DST. Another DST
in DSTs at that point.
And there might be a way to, claw your way back out of it.
I've heard something about that, but it's not easy.
Yeah. It's kind of like, again, like, that's why I said it's like your retirement. And I have great clients. That's what I have a guy that's doing that right now. It's a great option for him. He doesn't really need the money. He doesn't need a return really, but he wants to maybe sell this other property and put it into this thing and never have to worry about it, and doesn't have to worry about, anything regarding it for his kids. And so he's looking pretty strongly at it, but it is a thing where, you're pretty much in it until the end, unless you're super creative and probably spending a lot of money on attorneys stuff and CPA stuff. And, then I don't know, if you're really out of it or not.
I mean, maybe it's like your last leg, you're in your whatever 80s or whatever, and you figure, well, my heirs will get a step up in basis.
Yeah, you could do that. There's also some other pieces within there are the other negative pieces within the DST, which we just talked about, right? You have no control over it. So they make all the business decisions. They decide when it's going to sell. They decide everything about that property, which is fine. I mean, that's kind of what a mutual fund is, or whatever. You buy
it's like a REIT, basically.
It is. Although I will say that you do get the upside, and this is why I believe they work very well in an up market, because over the last 5 years, you saw a lot of DSTs, especially multifamily, even on practically new product, they still did very well because you do get the profit on the upside.
Right.
Versus REITs, you just don't get that. You just, it's just real estate flavored stock, as they say, right?
Yeah, exactly. And then the other piece to the DST that is difficult for some people to understand is it's not a stock. And some people say, okay, that's better, but it's less less moderated and it doesn't have to follow the securities exchange commissions that are on the stock market kind of stuff. So it's riskier. Now you got your funds, you got your your fund advisors, all those kind of things, but still riskier than potentially being in stock. I'm not saying it's riskier than investing in Facebook, but it's not like this thing's in the open public market. It's a publicly traded company. It kind of acts like it, but it's still riskier than that. So, the downturn could happen, and maybe the fund you selected was terrible, and they lost everything because, they actually didn't get those buildings built out, or whatever the case may be. So you got to be very careful, and that's when, in that particular case, you have to have a really good DST advisor, not just a financial planner. They know something about these kind of things, but I'm talking about an actual DST expert that can go in there and has done all the research for you and make sure that what you're putting money into, they have 20 years of experience. This thing hasn't been around for very long, really, when you think about it, but they have a lot of experience in it. Choose those guys and gals if you're going to go that DST route.
Nice.
Yeah, I think that's good advice. And also for people who are thinking about 1031 exchanging, we talked and you went over the kind of general parameters of doing a 1031, but they can get incredibly complex. There's reverse exchanges, there's exchanges where you're doing rehab and you want to fold in some of your money from your sale to pay for the rehab, and there are rules around all of that. And then, as you mentioned, if you're doing a tenants in common or TIC agreement where you're combining your proceeds with other people's monies, then that also can get very complex in terms of who puts in what and what their pro rata shares and obligations are for funding future rehab. So,
right.
So I think similarly, you definitely need to have an advisor.
Those complicate, those more complicated deals. There's people that do them all the time. There's people that rarely do them. Having and talking to the right people that fit your return requirements, as a 1031 person who's going through an exchange, is important. Make sure you know all of the actual implications of it, not just what the TIC advisor says or the asset manager tells you, but you got to know, okay, what is actually going on here? What's the operating agreement? Your attorneys are looking at it, all that kind of stuff. So you just need to be careful when you get into the more complex situations.
Yeah. Right. We're kind of butting up against our time because I know you have a hard stop here, but I did want to ask just generally, and maybe it's not off topic. So what's your outlook kind of going forward? Obviously you don't have a crystal ball, nobody does, but in terms of just kind of looking forward the next 12, 24 months, generally what's your outlook, and are you kind of shifting parts of your business in order to accommodate shifts in the market or not?
That's a really good question. Actually, we talk about this all the time. I'm sure you guys do too, right? But I think what we're seeing at this moment is there's a lot of what I call leftover product that's either coming online or that's online that maybe brokers have promised prices based on early 2022 numbers, right? They did a BOV in January, and here we are in July. The seller says, "Yeah, I'll sell it, for that kind of price." And the broker's probably sitting there going, "Oh my gosh, I don't know if I can get that price," right? And so we're on the side at Exchange CRE. We're on the side, we don't do listings, so everything we do is off market, right? And so we're direct to sellers we're going to promise the seller that we're bringing them offers on it, but we're not necessarily promising them a price or a broker of opinion of value on it. So what that does is it leaves a lot of these properties on the market for a heck of a lot longer than they used to be. And, I have seen it a little bit, not as much as I thought I would, but where properties reduce price. And then we're also seeing stuff where it comes back to our buyers. So again, we represent buyers. Maybe they put an offer in on something and the seller's like, heck no, I got an offer for, $100,000 or $1 million over that. Well, then, they go ahead and go out and try and get some financing, and turns out the numbers don't work with the newest rates. And so then they'll come back to us and say, hey, look, that guy didn't work out or that gal didn't work out. Is your guy still interested? and sometimes they are, sometimes they aren't. And then we also have the other side of that where sellers who maybe haven't been reading the news recently, I shouldn't say sellers, owners who haven't been reading the news recently, they think that their property is worth $2 million more than what it actually is now. That you got to kind of get over that hurdle. So, I mean, just in the immediate future, I think we're going to see more of that, but I do think we're definitely seeing more seller, reducing their expectations. We have a lot of anecdotal stuff of sellers says, yeah, I want $4.5 million for this property. And, I say, hey, look, I can't even get to $4 million, maybe not even 3.5. I said, what about 3.2? I mean, that's $1.2 million off of, whatever you first told me. But maybe, we're seeing those kind of things. And so looking out 12 months down the road, we know interest rates, at least at the Federal Reserve level, are going to continue to rise, next week and maybe in the weeks, in September or whenever else. However, we're also seeing, and I made a post on my LinkedIn page about this, we're also seeing that at least the 5-year Treasury note, which is where a lot of the commercial local lenders base their funding off of, has been pretty flat over the last 90 days. I'm not saying it's going to be flat next week, because we all know it goes crazy when the Fed does their minute release. But hopefully a lot of this stuff's baked in, at least in the near term. But we think it's going to keep going up. And then, next year, probably, at some point with the rising interest rates, we're probably going to be in some kind of recession. And now that doesn't, usually when we say recession here recently, everybody's mind immediately goes back to 2008, right? Because that was, the Great Recession. But there was actually a little, 14-second recession in 2020 with the pandemic.
Yes.
And that quickly faded because of, various reasons. And then there's most recessions are a lot shorter. So I'm always an optimist when it comes to recessions. They never last forever, but they always last longer than you want them to. So hopefully the recession we do have is short-lived. I don't know what it's going to impact and not impact, and that's why I always preach, keep buying the right properties. Because, if you look at the 1980s and the inflation period we had there, all those people that bought in 1981, 2, 3, they're sure as heck happy they did, and all those people that wish they would have bought it in 1981, 2, and 3, and then it's 1990, they're like, man, I really missed out. So those are things that we always keep an eye on. It doesn't mean make dumb decisions, but it means keep looking.
Yeah.
And then that way you have the opportunity to buy when you can.
And you said something really quick, and then we'll let you go. But you said something that was just fantastic, right? And I think I've said this in different words, but I'm of the belief that it is possible to make money in all markets in real estate. And it takes a little knowledge. Obviously, it takes some courage, right? Because you have risk. Risk is a big thing. And I think that alludes to that point that you made earlier about, it really takes a second for you to kind of put your thinking cap on and just look in and get some perspective and go, okay, I know I can do something here. How do I structure this? That's what's brilliant about real estate, because then you add in all the complexities and the levels and differences in between asset classes and lease types and tenant types. And there's an infinite number of ways that you can get in and do really, really well in real estate. Right.
Yeah. Great point. Great point.
So if this has been fantastic. If anybody wanted to kind of get in touch with you, maybe use your services, we're very bullish on Kansas City. And so how can they get in touch with you?
Yeah, the best way is, of course, you go to our website at Exchange CRE, with an X, kind of like it says behind me here, starts with an X, exchange-cre.com. I'm all over LinkedIn, so you can find me on LinkedIn, look for my name and my face. I'm also on Bigger Pockets, and you can email me, alex@exchangecre.com. Go direct to me, and I respond to all my own emails, and just look forward to being a guide in Kansas City or any market, really. So looking forward to it.
Fantastic.
Thanks, Alex.
Thank you so much, Alex. This has been great.
Yep. Enjoyed
Thank
having
you
you on
guys.
the show.
All right.
Yeah, thank you.
10X for Gen XYZ is hosted by Zach Winter and Markader Rios, co-founders of Prosperity CRE, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and building long-term wealth. If you like the podcast, please give us a positive rating and subscribe to be notified about future content. Also, if you'd like to learn more about our approach to real estate investing, you can download a free copy of our real estate investment book, Investing for Cash Flow and Long-Term Wealth, by clicking the link in the show notes below. Thank you and stay tuned for our upcoming episodes.